Good evening, everyone. My name is Connie and I'm the Director of NZ International Tax and Property Advisors. Welcome to the Strategies to Combat Interest Limitation on Residential Development. We've got lots of exciting material, so stay tuned. Feel free to post your queries during the webinar and we'll endeavour to answer all queries at the end of the webinar. We're stoked to have Alistair, Director of Macrae Property Broker, Blandon, Director of MHQ Mortgage Advisors, and Bibiana, Partner of Leung Law Firm, to talk to us about residential developments tonight. First up, I'll talk about the new interest limitation rules and the residential development exemption. Then we have Alistair to talk about how to identify suitable land for residential development. Then we have Bibiana, who will go through property law and regulations for residential development. Lastly, we have Blandon to talk about financing for residential developments and how to leverage equity in your existing property portfolio. I'll start with the interest limitation rules, inclusion and exclusions, details of the residential development exemption, common ownership structure for property development, and lastly, I'll cover off the top 3 considerations for property developers. Note the presentation was prepared while the new interest limitation rules are still in the making, so details have yet to be finalized and can be subject to changes. Before I dive further, I'd like to share how I cross paths with the property industry. So I grew up in a household where my family talked about issues they're having with their commercial and residential property investments. Their property investments were in residential and commercial, and I gained experience from helping my family with managing their property portfolio after graduating from the University of Auckland with a Bachelor of Commerce, conjunct with Bachelor of Property and a Master of Taxation degree. Over the last 10 years, I've observed and learned how issues were addressed, how risks were minimized, and gained a wealth of commercial and residential property consulting experience while working as a full-time tax consultant. I started investing in both commercial and residential property in my mid-20s after graduating and saved some funds for a deposit while working after a few years after graduation. While investing in both residential and commercial properties, I worked as a full-time tax consultant at a Big 4 mid-tier and boutique chartered accountant firm, lectured tax at university in Auckland, and helped my family with their residential and commercial property investments. I'm a chartered accountant and I started my own firm last year. We're a one-stop chartered accountant firm specializing in property tax and consulting, cross-border taxation for migrants, IRD disputes and resolution, and SME tax. Our clients are property developers, property investors, SME, expats, and migrants. Just thought it's quite useful to start with what's included and excluded from the new interest limitation rule. Residential development is only one of the exemptions, as you can see from the list. So for instance, new build is one of them, and we've covered that in our last webinar, and commercial property, which we'll cover in more details in the upcoming Saturday webinar. Another few interesting exclusions include land outside New Zealand. So say if you invest in overseas property, that shouldn't be subject to the interest limitation rule. Cross-border property tax is an area of our, that we specialize in, so we would be pleased to assist if anyone is considering this option. Flatmate and border income should not be subject to the interest limitation rule. Other exclusions include employee accommodation, farmland, care facilities, commercial accommodation, retirement village, and rest home and business premises. So to further discuss the residential development exemption in more detail, interest incurred on property development should continue to be fully deductible. The reason is because the government encourages increase in supply of properties. This exemption is intended to apply to any activity that results in a dwelling that qualifies as a new build, and to developers regardless of whether their strategy is to develop to sell or to develop to hold. As mentioned, so taxpayers in the business of property development like dealing in land or erecting buildings should be able to continue to fully deduct interest expense. However, if the property is not purchased for the development business, then interest should not be deductible due to the new interest limitation rule. If the use of the land later changes, say from private to business, and it's developed, then interest relating to the land should become deductible under the development exemption. For those that are not in the business of property development, the development exemption should still apply. So this includes one-off development or developers with the develop to rent strategy. And this also includes converting a single house into multiple flats, converting a commercial or industrial property to a residential property, relocating a house, and potentially certain remedial work that increases the useful life of the building, such as seismic strengthening. So exemption would start from when the development activity begins, and after development completes, the new build exemption applies, so interest can continue to be deducted. Here's a timeline that illustrates this concept. So I just want to run through a case study with you all. In here, this case study, Amber acquires a residential land from Will on the 1st of May 2021 for $1 million. Amber borrowed $500,000 from the bank to purchase the land and undertake the development work. The land has an existing dwelling on it, and after acquiring the land, Amber adds a new build to it. The new build received its code of compliance on the 5th of June 2022. Question here is the interest deductible on the loan of $500,000? If so, under which exemption and from when? And if not, why not? Perhaps you want to have a think about that for like 30 seconds and then put it in your chat box, and then we can further talk. Here we go. We've got some. Yes, so 1st of May, yes. That would be for the, which exemption, Wayne, are you talking about? Is it the development, or are you talking about the new build exemption? Yeah, so 5th of June. So, so I think Brendan and Wayne, you guys both got it right. So both are deductible, but it's under different exemptions. So the answer is that from 1st of May 2021, it is the development exemption, and then from 5th of June 2022, that will be the new build exemption, because that's when the Code of Compliance certificate was issued. So, during the development period, that would be under the development exemption, and then after the Code of Compliance certificate is issued, there will be the new build exemption. So throughout the period, there will be the Amber can fully deduct interest. So the most common ownership structure that I've seen for property development is ordinary company. Sometimes I've seen joint venture. Other structure can be used in this list, but the suitability is on a case-by-case basis. Taxpayers should consider short and long-term personal and business goals, and also weighing the cost and benefit for having and setting up that structure. Because setting up a structure means that there will be compliance costs on a yearly basis, potentially. Some of the reasons why ordinary company is quite common is because there's that limited liability protection for shareholders, and the ability to liquidate companies to minimize the risk of future creditors' claim, and also the lower tax rate at 28% compared to the highest personal tax rate currently at 39%, and also the trust rate at 33%. Lastly, I'd like to cover off the top 3 considerations for property developers. I think firstly, protect your assets. So, because property development is a risky business, so ensure your existing assets are protected before you start property development activity. So if anything goes wrong, your personal and other assets are not affected. Also, it is recommended to undertake the property development in a separate legal entity because of the limited liability protection for shareholders, but note that the director's risk exposure remains. Secondly, before starting the property development, ensure that the existing properties that you've already hold on hand are not tainted. So what I mean by tainted is that because land acquired when you're a developer or subdivider or by an associated person with them for purposes other than business, so it's not for the development business, it can be for private or investment purposes, and the property is disposed of within 10 years of acquisition, the sale of the property within that 10 years may potentially be subject to tax. unless any of the exclusion applies. So it's important to document when the property development activities start and finish, so property purchase prior to the start of the development are not tainted. And thirdly, when business cease development activity, the business should clearly document the date of cessation so that subsequent land purchases by the business or its associate are not tainted with the property developing label. Generally, the development business does not cease until the last item of trading stock of land has been disposed of. So here's some services we can offer to assist. So we offer a free 15-minute consultation for new clients. Our website has a booking system and my time availability shown there. We provide property tax compliance and consulting services, specializing in New Zealand tax and international tax. We can also provide verbal and written tax advice. And if you want to know more about us, you can visit our website at nztaxprop.co.nz. Before I pass you on to the next speaker, I'd like to give you a helpful guide for your next property purchase, which I'll share in the chat box shortly. As mentioned, feel free to post your queries in the chat box and I'll respond at the end of the webinar. If you prefer to contact me to further discuss, you've got my contact details on the slide. I'll now hand you over to Alistair, who will talk about how to identify suitable land for residential development. Over to you, Alistair. Thank you.